Hey, what's up, everybody? Welcome to another House of Bricks Live. It's hard to believe we're wrapping up 2025. I am feeling old. That is all I can say. But it has been a phenomenal year for the House of Bricks. We've launched our veteran initiatives. We've featured top CEOs, investors, pro athletes, and very excited about this. May be our last episode of the year. Not sure if we have one next week, but today's conversation is for founders who are building something meaningful. And those of you that know me, I've been doing this for 30 years. I'm going to do it the rest of my life, starting, scaling, exiting companies. And today I'm going to be joined by Reuben. He's an entrepreneur, impact angel investor, advisor, and founding partner at Washington Avenue Advisors and Ventures. Also the host of Flying with Founders, which I'm going to be a guest on his podcast coming up soon. And when I heard the title, I just thought it was a catchy name, but he literally takes founders in an airplane. And that's a great way to get me vulnerable, is when you're flying the plane to answer your questions and be authentic and transparent. But Reuben, welcome to the House of Bricks Live.
Yeah, thank you. I can't wait to have you up there. I think it's going to be fun.
Oh, it's going to be great. And you and I, we recently got connected a couple months ago, and love to hear more just about you and your story, kind of introduce you to our audience, and then we'll dive in.
Yeah, thank you. And I'm honored to be possibly your last guest of the year.
Yeah, and I hope I'm not your last guest on Flying with Founders. So
No. You will not be my last guest. That's bad. Yeah, Reuben Levinsohn, I'm happy to be here, and I've been looking forward to spending this time with you. Love the work that you guys are doing, by the way. And my background started as a founder. I started as a founder back in my 20s. And I think a lot of what I'm doing today, probably like yourself, is because of the experience I had as a founder, the things that I didn't have, the support maybe I could have used back then. I think that's where a lot of the expression and everything I'm doing today is like looking back and saying, this is how I wish I would have been helped and supported as a founder in my 20s. My first business was in the house painting business, and I saw a pretty neat way to improve and disrupt the house painting business with tech. And we were the first tech-enabled house painting company that kind of improved the user experience, the estimating process, the delivery and production. And we were able to kind of disrupt that industry with a much higher conversion rate because of the way we did it with homeowners. So it was a crazy, cool experience in my 20s. Built it up to become the largest non-union painting company in Michigan. And I sold it at the age of 30 and got into investing for myself and started investing for others and built a wealth management company out of that. We still have that today. My partner, Nick, manages our RIA. And we manage about $250 million of assets for business owners, entrepreneurs, founders. And everything we're doing today from there is around working with founders to help them from ideation through exit and ultimately their legacy.
Yeah, and over the last probably 18 months since I've started House of Bricks, I've probably talked to 600 founders. What do you see as kind of a common constraint when people are starting their first business or starting a business? And what did you experience early on in your first business you exited?
I'll give you like a little different one here. A constraint that I experienced that I recall and how I'm trying to help founders today was no boundaries, like not knowing when to have a boundary as an entrepreneur and founder as far as your time, the access to you, the amount of hours you're willing and able to work when you're that excited and passionate or desperate to get something off the ground. But yeah, without those boundaries, without healthy boundaries, I personally experienced quite a bit of burnout. I was in the hospital a couple times in my 20s. You shouldn't be going to the hospital with ulcers in your 20s. And I didn't know it at the time. I mean, I remember the doctor saying, like, you're dealing with a lot of stress. You need to learn to manage stress. And I was like, what are you talking about? I could barely manage my business. I don't have time to figure out stress.
Yeah.
But I think that's one of the things is just healthy boundaries, understanding that, self-awareness about yourself, what your body can handle, what your mind and your heart can handle. That's just the first thing that comes to mind. There's so many other things.
Yeah, and I can relate to that. I, started my first business out of my apartment with a couple $100, had a multi-million-dollar exit when I was 27. So it people don't realize really what it takes to start a business. And we talk about that in the House of Bricks, right? Understanding the season that you're in and understanding that there will be collateral damage. To build something great, there's a cost. It could be a cost to your family, yourself, your relationships. And so for founders that are listening out there, like you said, people are like, yeah, manage your stress. Like, okay, yeah. When would you like me to do that? So is there an easy thing a founder could implement now that isn't going to disrupt, some of that building process?
I created my own version of this. I made a tool out of the aviation industry called PIREPS, PIREPS. It's in the aviation and flying, it's pilot reports. It's short for pilot reports, and it's critical in-flight information you get from other pilots when you're up there flying, and tower can only tell you so much, but you need to know, like, what's that weather really like over there? Or is that turbulence really bad? And you can get a quick pilot report, a PIREP. I've converted that acronym for the founders I work with to physical, intellectual, relational, emotional, professional, and spiritual. And I have them do a quick self-awareness check with PIREPs that I can text them, or sometimes I get random texts, especially founders who've been on my retreats, and we work on this self-awareness tool. But they'll give me a quick PIREP score. It's like P4 or I6. And I can quickly go, whoa, what's up with the 4? Why are you so low there? And I think it's really important just that they get self-awareness tools and ways of checking in with themselves, and then even using that with their leadership teams too, because it's easy, I don't know about you, but in the companies I've built, I can look back and see how I burnt out some really good people. I would probably still have them in my business if I didn't burn them out, but it took me too long, well into my mid-30s, to learn how to have that sort of self-awareness for yourself and your team. But tools like that are helpful. And then I'm really passionate about doing these founder retreats. We do 3 of these a year. We offer them 3 different ways. We've got one coming up in El Salvador in January. I've got a great group of founders that'll be joining us there. But we really take that time to, like you said earlier in your intro, you get a little vulnerable when you're in the plane. Well, when you travel and get out of your comfort zone, you also see things different, perspectives a little different. You're able to energize a little differently. And so on our retreats, I'm always excited to sit them down and just take a breath with them and say, wow, what a year. Like, look back at what a year, what all the milestones, all the things you've done. Let's take this time though to check in with ourselves, make sure we're healthy, we're not burning out, that sort of thing.
I could have used one of those retreats multiple times over the last couple of decades, that's for sure. But yeah, taking the time to get around like-minded people, because being a founder, being a leader, you're surrounded by everybody, but you really have nobody that you can turn to because you're leading your team. It's tough. And as a founder early on, you're struggling with sales, cash, managing your team, and then still trying to manage and lead yourself. So when I was preparing for the show, just kind of reading some of the notes, I appreciate you being authentic and transparent. I talk more about my failures and how those turned into success than the success itself. But you kind of reached a point in your late 30s where everything hit the fan. Can you take us there?
Yeah, it's interesting. I had no idea. I think I noted in there, like, at 17 years old is kind of like the first real impact moment I remember, because my parents claimed bankruptcy and divorce that year. Two major things that you had to experience as a 17-year-old. And quickly became like the parent of my younger brother and sister, had to help my dad out financially. Fast forward into my 30s, like, I went 2 straight decades of just working like a crazy workaholic entrepreneur. And I didn't know exactly why. I knew that in my head, like, I don't want to repeat what my parents did, right?
Yeah.
I want to make sure that doesn't happen. So I was willing to work harder, faster, longer than anybody around me. And that was not sustainable. I don't know how I kept that up for 2 decades, but pretty much by late 30s had burnt myself out. I mean, I remember literally driving back from Indianapolis, back up towards home here in Lansing, And I pulled over. I couldn't even drive. I started crying. I pulled over. You talk about failure. Like, this was major bottoming out failure point where I pulled over, couldn't remember what I was doing, where I was going in life or in business. Like, it was
Yeah.
all, or on the road. I didn't even know where I was headed. And I felt completely exhausted, completely burnt out. Like, 20 years just caught up with me. And I had to get some coaching. I had to get some help to get out of there. I realized I had burned out my marriage at that point. My wife was along for me all of that 20 years, but she never felt like she was a priority with everything I was doing. Yeah, I'm pretty open talking about those failures with you, and I'm with you on that.
Yeah, I'm smiling because, I've ended up on the bedroom floor, don't know how I got there, driving down the road, you forget where you're going. Like, you can really burn yourself out. And you mentioned advisory and coaching, and that's really my passion now, is working with founders. And it's not that I have all the answers. I have all the mistakes I've made that won't let you skip the struggle zone, but you can optimize in that process. Yeah. And advisors, investors, coaches, just like Michael Jordan needed a basketball coach, right? And he's the greatest basketball player to ever walk the face of the earth. Us as founders, CEOs, everyone needs a coach. You need someone that's outside of the business, right? That can see in, and also surrounding yourself with advisors and investors that actually care about you, right? So my interactions with you already in your fund, I can tell, there's the devil's always in the details of when you take investors' money, like, what is their goal? Yeah. And, do they have some regard for you as the founder, and, how long, you're pushing. And one thing I wanted to ask you, were there kind of some warning signs along the way? I mean, obviously, pulling over the side of the road, crying, there had to be things that led up to that you maybe ignored.
Yeah, I wish someone would have pointed them out for me, because you don't notice them yourself. But when you look back, those warning signs were all there. And it took a little getting a coach and getting some help for me to start to see those myself. And a good coach, I was fortunate to find a really good business and kind of life coach at the time, and stripped things down and said, helped me see that what I was really operating from, what was fueling me, was fear. And I didn't know that. While you can be fueled by fear and be very successful, but it's not sustainable. So for those 20 years, my fear was that I was going to end up like my parents, bankrupt, divorce. And so working that hard from that fuel, it got me a lot of success. Built a very nice business, had a very nice exit by the time I was 30, and then started building another in the wealth management, built a really nice business in my 30s there, and built another team. And that, fortunately, I learned the lesson early enough on the second time around that I didn't burn that team out and lose the business. That team is still with me today. They're my partners. When I realized that I was operating out of fear and I had to change that, I had to re-identify everything I was doing. I had to strip it all down and reinvent myself and reinvent my why, and really dig deeper on that. But one of the things I realized is, like, I'm a really good 0 to 1 person. I'm really good at connecting the team and getting something up and running and building on the front end. But I needed operating partners. I was trying to operate these businesses, and that wasn't my strength. So was able to figure that out early enough and identify some of the best people around me that were working with me, and make them my partners. Will you be my business partners? No longer want you as employees. I want you as partners. Like, run this thing, because I'm not great at the long-term sustainable operations part of it. That's where I would burn out.
You and I are cut from the same cloth. So good thing Paul's not on camera now, because he's like, oh my gosh, this is Adam, Mr. Visionary. So, my favorite is just taking things from a napkin and turning them into reality, right? Getting the team, getting the passion, the vision behind it. And then, like you said, finding a good operator, integrator that can help execute. And I saw an interview with Jeff Bezos. He was saying early on in Amazon, one of the investors came to him and said, Jeff, you have enough ideas to destroy this entire company. So, putting that, throttling that vision, it's having the right people around you trust that can actually push back. But
well, I'm sure you too, but I've come to appreciate my operational partners more than anything. Like I've had people ask me, how are you involved in so many things? Like, because I'm blessed with good partners. I couldn't do any of this without them.
absolutely. And a lot of founders, they think burnout is the cost of ambition, but it is until it starts costing you the wrong things, your health, your relationships, your team, like you said, burning people out. And I've had to make an adjustment in my leadership style, having worked for Dan Gilbert early on in high school, mid 90s, understanding kind of the difference between top-down leadership and bottom-up. So I really try to get my team's input first, and you can always override it as a leader, but most of them will come up with similar ideas to you, but they take ownership because it comes from them. And so I've found that shift kind of as I get older in life to really get that collective buy-in from the team. So part of the House of Bricks, we talk about testing, failing, learning, and growing. And it's a framework we've developed, not really a theory, but a way to honestly look at the decisions you're making. What do I want to test? Okay, I failed. What am I learning? And then that's where the growth happens. Most founders, they're either people are afraid to even test. And then if they test and it fails, they don't like how that feels, so they don't learn from it and do it again. And then, going through that iterative cycle and flywheel, that's where real innovation and the compound effect takes place in the business. So what do you see as kind of something that you have gone through that process in starting your business, something you tested that made a big impact, or you failed, and what'd you learn from it and how did it create growth?
I mean, clearly the failure we were just talking about for me was trying to maintain sole ownership of my company and run all the, lead every part of it. That for me became a failure, because not that some people can't do that. I've seen solo founders build amazing businesses, but I realized for me, like I couldn't manage myself that way. I didn't have the energy for that. So getting the right partners in place that we all complement each other's strengths and weaknesses so well. Another one would be like, when I think about your test, fail, learn, grow, I think about flying. And since you're going to fly with me, hopefully this doesn't scare you, but
hold on, we're doing test, fail, learn, grow in a plane.
We're going to do it in the plane. Yeah, we got to. We'll talk about, some mock scenarios, like emergency mock scenarios that we train for. In getting your pilot's license, most of what you train for is the failures of a plane, right? So you're testing things in failure mode. So I'll be flying along with my flight instructor many times, and he's a younger guy. He's actually a tech founder. If he hears this, he knows who I'm talking about, but he's a punk, man. Sometimes we'd be flying along. He'd just get me talking about stuff he knew I enjoyed talking about, so I was distracted. And then he would, when I wasn't looking, he'd pull the engine. All of a sudden, you're a glider. You've got no power. And he'd say, your engine just failed. What are you going to do? And I'm like, it's not even on my mind. We had just complete failure of the engine. And he'd pull the engine, and you got to be able to think quick. It's for us, it's having a system. You've probably heard that saying, like, you can rise to the level of your ambition, but more importantly, that you don't fall below the level of your systems.
Right.
And so as soon as that engine's out, for me, it's ABC, quick checklist, airspeed, best place to land, and my checklist. So quickly, I'm looking at my airspeed. I'm going to peg the right airspeed, 72 knots. I can't go below 72 knots. That's my most efficient airspeed without an engine. And then next I'm looking at real quick, I got to figure out where's the best place to land, because if I'm at 5,000 feet, I've only got about 5 minutes, maybe a minute per 1,000 feet. I'm going to be on the ground. And so it's all about 5 minutes. I've got to make sure if this engine, if I can't get it back on with my C, which is my checklist, can I go through and see if I can get the engine back on? Assuming you don't, you're calling in Mayday, Mayday, you're doing your comms reports, your location, and you're telling them I'm going down right here. And that's it. Like, that stuff happens fast. So in the test, fail, learn, and grow, flying and training for that is a really interesting way of experiencing that.
For sure. And I think I have another meeting the day we're supposed to do that.
I won't do that one to you. I won't.
Yeah, no, that's fine. I'm all for it. So, relating that to business, I know you had a business that you spent about 10 years building and you decided to sell and you genuinely believed it was ready. You had a buyer, a bank willing to finance most of the deal and looked like you had a clear path forward. What assumptions did you make thinking that you were ready?
Yeah, so I was ready. That's the assumption I was right about, was that I was ready to sell. The wrong assumptions was that the business and my leadership team were all ready. And where I failed the most on that assumption was that the buyer was ready to run this business. You talk about due diligence, right? Buyers do a lot of due diligence on the business they're buying, but sellers don't often remember to do reverse due diligence on the buyer. You're just kind of like, I want to be done with it. I got a buyer. I'm out. I got a check. And I was 29, 30 years old. So I'm going to give myself a little bit of grace that, you don't know a lot of these things in your 20s. And this is probably why I'm doing the exit planning, the Healthy Founders, Healthy Exits cohorts, first of its kind of exit accelerator to help founders understand what really goes into being ready for an exit and being attractive to buyers, because of what I experienced. And we didn't do reverse due diligence. Nobody talked to me about reverse due diligence on the buyer to make sure they were prepared to take over the business. So in that case, I got 80% of my money up front. He financed it. Fortunately for me, this was 2005. And if you remember 2008, 2009, we had a very significant recession, economic crash. My financing never would have happened after 2008, but in 2005, 2006, when my deal closed, things were pretty good. Banks were financing a lot of deals. This buyer was able to get 80% of the purchase for me financed. I received a check. 20% was a seller note. I never got the rest of that seller note because of the failure of this one. That buyer was just not ready for this business, and we didn't do any diligence on that. So 6 months later, I ended up getting the business back. Couldn't collect on the 20% note. I ended up building it up a little bit and reselling the business to recoup my 20% note.
We are cut from the same cloth. So my first business was selling leads to mortgage companies, and we rode the refinance wave from 1999 to May of 2007. So I had a buyer in January. We had a term sheet, and there were some rumblings about the financial crisis. We hit our numbers in January, February, March, April, and then May 11th, he calls me. He's like, let's do the deal. Where's the money? And not within.
And then it went
30 to 45 days. Like every one of our clients were going out of business, countrywide, Northwest, you name it. And I had a year earn out, but it didn't matter how much I worked. Like mortgage companies were going out of business. So I left about.
No, that was like going into a mortgage pandemic. There's nothing you could do.
Nothing I could do. So I fortunately was able to negotiate 90% up front. And like you, certainly didn't collect the earnout dollars. But with, the different, right now, I was going to ask you, I help, founders kind of prepare to raise capital, putting together their investor presentations, their financial models, all of that, go-to-market strategy. When you're being pitched by a founder, I take a different approach where they're actually asking questions to the VC or the investor to make sure they're a right fit, kind of qualifying them. And I think that ties into what you're saying about qualifying
reverse due diligence. So it's like reverse due diligence.
Do you find many founders lead with that, or do they just pop up their deck and, hey, here's slide 1 through 20? And
yeah, it's funny you asked that, because I said this to someone else recently also in an interview. They asked me something like, what do founders not do that they should on these pitch calls? And I said, well, if we open up the beginning of the call and say, hey, it's your time. This is what we always do. We always say it's your time. Use it how you'd like. Feel free to ask us questions if you have questions. Pull up the deck, whatever you want to do. 95% of the time is pull up the deck, start presenting, because that's what they're conditioned for.
Right.
But I think it's smarter if they use that time to get to know us and ask us you can ask some really good questions, like, what's your thesis on the fund? What are you guys focused on? What are the last couple investments you made and why? Like, you're going to get a lot of information out of us around that. Do the diligence on us. And if there's a way to do that prior to the call, even better, because at some point on this call, you've got to present to us. We got to know what we're looking at.
Right.
But if you could get a little bit of those questions, or if they sent us those questions ahead of time, not only am I going to be impressed with that, I'm going to take them serious. And I'm going to think they're pretty serious about what they're doing and how they're raising funds and who they want to work with as an investor. So yeah, it does go back to, like, they should use that to do a little bit of diligence on us. I'm sure you've been to some of those reverse pitch events where the VCs have to pitch instead of the founders.
Yeah.
Those are always fun. Sometimes they do them as a joke, but I think they're actually useful to learn about VCs. Yeah, you need to know if they're going to be a good partner. You need to know if you're even talking to the right one. Does their thesis even fit what you're doing? Yeah, I think that's important.
Yeah, and right now, like I said in the introduction, right, you're the founding partner, significant shareholder in multiple companies. From your vantage point today, like, what's the most common blind spot you see in founders when they're raising capital or just even in their business in general?
Well, this one's easy for me, Adam, because I've been preaching about this for a while now. This is what it started with some frustration, and I started to really dig into it, and I've got compassion for the founders on this problem. And the problem is they, at early stage, have learned how to sell investors on, invest in my company, I'm going to do X, Y, Z to scale it, and then we're going to exit and you're all going to make money. That's what we all hear, right?
Yeah.
But if you start digging into that, and I have quite a bit of insight into what it really takes to be acquired, to be attractive for acquisition and to get acquired. So do you. But my company, my partners are CEPAs, Certified Exit Planning Advisors. Like, we do this professionally. We've been doing it for years. We help business owners set up for an exit. We're not the broker. We don't transact the exit. We're doing all the meaningful work to give them a healthy exit. So my whole thing is in my title right here on your caption: Healthy Founders, Healthy Exits. The biggest blind spot, they've learned to sell us on they're going to build a company and exit, but they don't know what that means. They literally don't know what that means to take a company through an exit, and a good one, like a healthy one that they're happy with and investors are happy with. We hear about exits all the time, but how many of those are the founder and the investors actually satisfied with the results, and was it really what they were after? So yeah, that's why I've been talking a lot about it. It's an epidemic we've been seeing, especially over the last couple of years, as IPOs have been down, and that trickles down to a lot less M&A activity in venture. Venture capital has had its roaring seasons, and right now it's, since 24 when I raised my fund, which was, by the way, I saw the stats in 25 when they did the look back. PitchBook said 24 was the worst year to raise funds in a long, long time. And somehow we raised a fund. It was hard, but we raised our fund in 24. 25 has been all about investing in companies. And one of the things we really dig into is when they tell us they're going to exit, do they actually put thought into that? Do they know what that means? How are they going to exit? Who are they building it for? Who's going to buy this? Has that company actually made acquisitions? How are they valuing your company? That is, to me, the biggest blind spot. And that's why in 2026, I'm really happy. We're going to launch a first of its kind. We're going to partner with some VCs and some exited founders to launch first of its kind exit accelerator, a cohort for 8 to 10 founders who are serious about building for an exit, to kind of work together on and come out of that with an action plan on how to get the company to an exit.
Yeah. And I don't know, just in terms of, the businesses you've started and sold, but how important is domain expertise? And the reason I'm asking, if you look at the 7 companies I've started, they've been in healthcare, mortgage leads, mobile technology, all different industries, but I've been able to identify patterns in business, right, that can apply to any industry. When you're talking to founders, how important is their industry experience?
Well, I think what you said, though, that's good. If you can identify that and explain to the investor that you are really an expert at identifying patterns and trends in different businesses and building for that and solving that problem, that's worth us knowing. Um, because otherwise it does catch our attention when what most often catches our attention is when we recognize that we're talking with an SME, a subject matter expert in the category that they're building a solution in. So someone who was in aerospace for 20 years saw something they could fix and broke out and did it. If you look at our portfolio right now, I could definitely start to say PaveWise, who we recently invested in, Livesy, a prop tech, one's a construction tech. Those are SMEs. These are founders who are subject matter experts, spent 15 to 20 years in that industry, dealt with the problems firsthand, and decided to go all in on a solution for it. And we like those. Having a subject matter expert who's the domain an industry expert that decides to build something for that industry is very attractive to us.
I do like that. And I also like the fresh perspective of someone that's not in the industry. It's kind of like having a coach or advisor that can come in, look at things differently. So, I've always hired kind of that subject matter expert, or I find a guy with the idea, but they don't know how to get it from napkin
Right.
to
Like
reality.
I'm the founder who struggled with his exit, but I'm not a certified exit planning advisor. I've got partners in my company who are certified exit planning advisors. They're the experts on it. And yeah, just like you said.
Next question. This is one of my favorites is what is more important, the jockey or the horse? So do you look for founders that have already had an exit? Does that weigh more than the actual idea and concept itself, or is it the other way around?
That can go both ways, right? It's always at the early stage, my answer is always going to be the jockey because when you're at such an early stage, it's so much is dependent on the founder, their persona, their IQ. When we meet them, like I already know they're brilliant. They're a brilliant technician or a brilliant creator or a brilliant go-to-market specialist or problem solution fit is perfect. Something they've done is brilliant. We already know that, or they probably wouldn't be talking to us.
Right.
But more importantly, have they invested in themselves? Kind of what we talked about at the beginning. Have they invested in themselves from an EQ perspective, emotional intelligence? Do they really dig into understanding their identity, their talents, and doing that with their leadership team? I can't get past that because that's the stuff I lacked in my 20s and 30s and took me so long to develop, to be able to build things in sustainable ways and actually enjoy doing it. So we want to see that. I want to see that in them when we can.
I forgot to ask this earlier. The pilot aviation dashboard that you have for founders, is that something that's readily available on your website, or if people do want to use that, or is it for founders you've invested in?
No, the way we've been utilizing that and deploying that is through our retreats. It's the Healthy Founder retreats.
Okay.
I'm a big believer in the retreats we're doing. We make them very simple. My daughter and I host founders 2-3 times a year. January we've got coming up. We always do the international one in January. So this one's coming up in El Salvador, January 6th to 12, and we'll have a group of founders there. And that's where we really bring out those tools and work with them. And then they carry them on from there. But no, I don't have I like that idea. I think eventually we will have like the cockpit, on a website or something where you can get all these tools. But it'll probably be a subscription model, something. I mean, these are tools that'd be hard to figure out if you didn't have a cohort to go through or come on a retreat with us.
Yeah, as a business idea for me, my mind's running like there could be a recurring revenue component there.
Serial entrepreneurs here, it wouldn't be out of the question for us to launch a business together after this podcast.
It's already started. I just texted you the business plan. So,
but AI, we've already got it in the background, getting the whole pitch deck ready.
Yeah,
we'll probably have it. Funds will be raised for it by the time we're done here.
I would love that. Well, a couple more questions here, and I appreciate you jumping on here during the holidays. But what one of the questions founders always ask me is, how do I value my business? And there's all kinds of methodologies out there, discounted cash flow, EBITDA, revenue. Early on, it's pretty tough to have solid metrics, but what's kind of your process? Someone comes in with a $10 million valuation. First of all, most founders don't know how they got that number. But what methodologies do you use, and what is the best way for them to back into that valuation?
Very different answer when we're doing the exit readiness work with them. When they're getting serious about exit, we're talking about valuations for more traditional methods like you were getting at with EBITDA multiples and stuff like that. But very different would be at the early stage when they're raising money, and how the values are set. It's set by your lead investor, or the founder throws a value out until the lead investor disagrees with it.
Yep.
So I do talk to them about that in our monthly meetups. We have a inside the mind of a VC. We do just a monthly, there's no cost or anything. Founders can jump on and we just talk about whatever, but that comes up a lot. Like in the early stage, yeah, you might put a 10 million value cap on your SAFE agreement because your lead investor is okay with that, which sometimes I think we look at those and we're even like, who is this investor that was willing to put a 10 million value cap on this?
Yeah.
But as things have changed, in the last few years, valuations have gotten a little more reasonable, realistic, especially here in the Midwest. We're currently mostly focused as Midwest investors. Our fund, Exit Quotient Ventures, is Midwest focused. And you get more reasonable valuations here in the 5 to 15 million range at seed stage, when they're just kind of coming up on their first $500,000 to $1 million ARR. But that's how they're set at that stage. Later, and this is why we're doing these cohorts, to help them understand, like, now you've raised a seed, you've raised a Series A, you're doing 2 to 5 million of ARR. You've got a real company. You've got 25 employees. We've got health benefits in place. You got to really start to understand valuation and how you're looked at now, because it's not just from your investors anymore. And maybe at this stage, they're doing 409A evaluations. I think that founders need to start understanding the difference of raising money and what a value is, and a real valuation with a 409A when you're setting stock option plans and stuff like that. There's such a disparity between what your last investor round would value you at and what your 409A says. Somewhere in the middle there is what buyers are going to look at, or what your strategic investor coming in on a Series A to help you scale for an exit is going to look at. But yeah, they're definitely at some point going to start looking at profit multiples, right? Because like a real company. But to your point, it just depends on the stage, how you value it.
Yeah, and the capital raising process is one thing, but also the fiduciary responsibility of taking other other people's money, right? You're investing, you have a responsibility.
I'm glad you said fiduciary responsibility. I say that all the time. No, founders don't even know what that means.
Right. Yeah.
VCs don't even know what that means.
Yeah. So like my first business, it was bootstrapped, idea to exit. And then my second company, Velocitude, that was acquired by Akamai. And we talked about valuations. I was able to get somewhere between 28 and 30 times revenue. So you never know when the right buyer will come along. It could be a speed to market play. I mean, we were just a rounding error to Akamai, but getting that right investor. But the important part was we were ready for we were running the business in a way a buyer that came along, could, we were ready, and that's kind of the process we've built with our simple operating system.
You had the proper financial controls in place for them to see. We call it monopoly of control, or you weren't too dependent on any one supplier or vendor or customer concentration. Like, so many things we go down. We call it the 8 drivers. And when we take founders through this, we help them understand the 8 core components that buyers are going to be looking at to value you.
Can you run through those 8 for us real quickly?
I don't have all 8, but a couple of them, like monopoly of control or Switzerland structure, financial controls. I can send you some stuff on this. You might want to put it in the show notes, but it's really good walking through those pillars of a company that buyers look at. And some of it has to do with simple things like how founder-led is the company at this point. Hopefully not too much founder-led. Like, we said at the early stage, you're betting on the jockey. Well, later stage, they want to bet on the horse. They don't want to bet on the jockey anymore. So you got to make sure it's not as founder led if you want high value, right? Those are key things. And yeah, I could send you the 8 drivers. You could put them in the notes.
We will for sure. And you've got those 8 drivers, which is great to identify them, but knowing which lever to pull when and how hard is also very important. Like, all founders think they need is sales and cash. We just need investment money and more sales. Like, no kidding, but like, what is that doing to the foundation of your business?
I think of it like getting your house ready for sale. If anybody's gone through the process of selling a home and you get a good real estate agent or someone to consult you on it, they're going to say, where are they going to tell you to put the money while you're getting it ready for the house? The kitchen and the bathrooms, right?
Yep.
So in your business, where should you put the focus? Where should you be investing in infrastructure and strategy and money? Well, that's what the 8 drivers really help founders understand, is this is what buyers are going to be looking for. Don't worry about the other stuff.
So as we wrap up here, what are you working on today? What has you excited and passionate? And if people want to get connected with you, other than us, we'll put your website, contact information in the show notes. But what are you working on now that you're passionate about?
Well, flyingwithfounders.com is easy, and you can find us on all socials. We don't do the long form podcast yet. You guys are doing a really good job of that. I have all our stuff short form right now. But we're on all social platforms with Flying with Founders. And that's also where we'll announce and share information about our retreats for founders. And more importantly, the thing I am most excited about is this first of its kind exit accelerator focus. And we're going to do this in cohorts, maybe 2 cohorts in 2026. And this is for well-funded founders who are on their way. They've got 2 to 5 million of ARR. They're not scrapping to put their rolling fundraise together to get through the next 3 months.
Yep.
They're thinking strategic, and they've got significant pressure from VCs and investors on their cap table to either scale or clean up the cap table, redeem some early investors out, and get ready to look attractive for an exit. That's what I'm excited about, because that's a lot of what I wished I had as a founder. And we'll be doing that in 26 and partnering with VCs and other experts, exited founders like yourself, to be able to share the do's and don'ts with them about how to get to a healthy exit.
Well, I can't tell everyone listening enough what Reuben is talking about. I've lived it. He's lived it. Every founder has lived it at some point to some degree. So all my interactions with Reuben, his fund has been fantastic. If you're raising capital, definitely reach out to him, learn more about their fund, and do your homework before you get on the phone with them. We're giving you some great tips that will separate you from 99% of the founders out there. Do your homework, ask questions. But Reuben, want to thank you for joining the House of Bricks Live. And we're both here in Michigan. I'm looking forward to flying with founders, and I appreciate you joining the show as we wrap up not only the show, but 2025. So it's a great way to close it out. Great advice from you. So I appreciate it. Any closing thoughts for our listeners?
No, I appreciate it, Adam. Thanks for having me on. And what a year. I can't believe it's coming to a close. Here we go.
I appreciate that. Happy holidays to you and your family. Happy New Year, and talk to you soon.
Too. Thank you.
Thanks, everybody.